Hey everyone, welcome back. Today we're tackling a topic that every real estate investor needs to master: how to avoid capital gains tax when selling your rental real estate. If you're looking to keep more of your hard-earned money, this video is a must-watch. Stay with us. Capital gains taxes can eat up significant portion of your profits when you sell a rental property. However, with the right strategies, you can legally reduce or even eliminate these taxes. This is crucial knowledge for any investor who wants to maximize their returns and grow their wealth more efficiently. Let's break down into the 3 actionable steps. Step 1, you're going to utilize the 1031 exchange. A 1031 exchange allows you to defer paying capital gains taxes when you sell a property, as long as you reinvest the proceeds into a similar type property. This is a powerful strategy to keep your money working for you rather than handling it over to the IRS. Step 2, leverage the primary residence exclusion. If the property was your primary residence for at least 2 of the last 5 years, you might qualify for the primary resident exclusion. This can exclude up to $250K of capital gains for a single filer and $500K for married couples. Plan for long-term capital gains. Step 3, finally, you've held the property for more than a year. You'll benefit from the lower long-term capital gains rate. This is significantly lower than the short-term rate and can save you a substantial amount of money. The 1031 exchange, named after Section 1031 of the Internal Revenue Code, is one of the most effective strategies for deferring your capital gains taxes on the sale of an investment property. By reinvesting the proceeds from the sale into a similar property, can defer paying taxes on the gains until you sell the replacement property. This allows you to keep your capital working for you and potentially grow your investment portfolio more rapidly. To qualify for a 1031 exchange, both the relinquish the property and the replacement of the property must be held for investment or business purposes. The properties do not need to be identical, but they must be in the like kind, which generally includes most types of real estate. The exchange must be completed within a specific time frame. You have 45 days to identify potential replacement properties and 180 days to close the replacement property. It's crucial to follow the strict guidelines set by the IRS to avoid disqualification. This includes using a qualified intermediary to facilitate the exchange and ensure that the funds are never in the direct control, your control. Proper documentation and adherence to the guidelines are essential to a successful completing a 1031 exchange. Working with experienced professionals such as tax advisor and a qualified intermediary can help navigate the complexities and maximize the benefits of this powerful tax deferral strategy. The primary residence exclusion is another valuable tool for reducing the capital gains taxes. If you have lived in the property as a primary residence for at least 2 of the last 5 years before the sale, you can exclude up to $250K of the capital gains for the single filer and $500K for married couples. This exclusion is significantly reduce your even eliminate your tax liability on the sale of your home. It's important to note that the 2 years do not need to be consecutive, and the property must have been your primary residence for at least 2 years within the 5-year period. This exclusion is available once every 2 years. If you sell another primary residence within that time frame, you may not qualify for the exclusion again. To qualify for the primary resident exclusion, you must meet the ownership and use tests. The ownership test requires for that you have owned the home for at least 2 years, and use test requires that you have lived in the home for a primary resident for at least 2 years. These tests ensure that the exclusion is available to homeowners who have genuinely used the property as their primary residence. In cases where you have a home, office, or rental unit within your primary residence, only portion used in your primary residence qualifies for the exclusion. Properly documenting the use of the property and consulting with a tax advisor can help ensure that you maximize the benefits of the primary residence exclusion and avoid the potential pitfalls. Holding onto your rental property for more than a year can significantly reduce your capital gains tax liability. Long-term capital gains are taxed at a lower rate compared to the short-term gains, which are taxed at an ordinary income. The long-term gains tax rates from 2023 are 0%, 15%, 20%, depending on the income level. This is substantially lower than the highest ordinary income tax rate, 37%. Benefit from the lower range of the capital gains tax rate is important to plan your investment strategy with long-term perspectives. This means holding onto the properties for at least 1 year and a day before selling them. By doing so, you can take advantage of the lower tax rates and potentially save thousands of dollars in taxes. It's also important to consider the timing of your property sales to optimize your tax situation. For example, if you anticipate that your income will be lower in the future, you might consider selling the property that year to benefit from a lower capital gains tax rate. Additionally, spreading out the sale of multiple properties over several years can help manage your tax liability and avoid pushing yourself into a higher tax bracket. Consulting with a tax advisor can help you develop a tax-efficient investment strategy that takes advantage of the lower long-term capital gains tax rate. They can provide guidance on timing your property sales, identifying opportunities for tax deferral, and optimizing your overall tax situation. To sum this all up, you can avoid the capital gains taxes by utilizing the 1031 exchange, leveraging the primary resident exclusion, and planning for long-term capital gains. If you want more tips on how to manage your real estate investments, check out our video on investing in real estate, how to get the best deals. If you enjoy this video, please like, subscribe, leave any questions or comments. I'll be answering them in our next Q&A session. Thanks for watching. I'll see you in the next video.